Okay, welcome back to economics. This is Dr. Kling. And today's lecture I titled somewhat whimsically, Who's Your Demand Curve? The idea is that there are four sort of prototypical market structures. And the demand curve looks a little differently for a firm depending on which market structure it finds itself in. So one market structure is that I'll call pure monopoly, and this is, don't worry about these letters that I'm going to use, that's just my own shortcut. I'll call that PM. Again, you don't have to remember that. I'm just going to use that so I don't have to keep writing monopoly all the time. And then there's something called perfect competition. And I'll, again, using my own letters, PC. Then there's oligopoly, which I'll call O. And there's something called monopolistic competition, which I'll call MC. Okay? Alright, so there are these four types, and they have different demand curves, but let me tell you more about them before we get to the demand curves. Okay, so we have monopoly, perfect competition, oligopoly, and monopolistic competition. Okay, so a I'm going to call this type of good. I'm not sure what the right category is, but a monopolist sells something unique. Okay, so nobody else can sell it. That's why it's called a monopoly. Perfect competitor sells what we call a commodity, meaning it's very standard, it's in a central location, so maybe I'll write these things down. Standard, it's in a central location, I guess that's kind of enough. So it's hard to think of examples of something like that. The only thing that comes to mind is things like the centralized exchanges where they trade commodities in Chicago, in the futures markets and so on, the grain markets, where there's the standardized grain or standardized foreign currencies or things like that. Or the New York Stock Exchange, but so there are very few examples. Another example I thought of is like if you go to some underdeveloped countries and you go to a tourist area, you might notice that at the that the vendors selling souvenirs are all selling the exact same souvenirs. So there it looks like it's almost a perfectly competitive market because there are all these vendors selling exactly the same thing in exactly the same location. So that might be an example of perfect competition. So we have monopoly is unique, perfect competition, that's the other extreme, it's just a commodity that you can't tell the difference from one seller to another. So that might be a good point. No difference between sellers. Okay, an oligopoly sells something that an oligopoly means only a few firms, so just a few firms. So maybe I should have put this down first. Number of firms. One, few, many, and I'll warn you that that's also going to be many. There are many in a monopolistically competitive industry. Okay, so few firms selling So pretty much a well-defined product. So oligopolies that we have, like for example the cell phone providers, there are not that many cell phone providers. There are just a few. They're well-defined, and the brands are well-known. I mean, we know who the sellers are in the cell phone market, or in the like broadband internet. We know, the cable company and the local telephone company, and maybe some smaller providers, satellite. There are not that many providers of broadband internet. So that's example of oligopoly. Monopolistic competition is sort of, we call these products slightly differentiated. So one gas station differs from another in part because of location. It just might be a little bit more convenient to go to one gas station than another. A restaurant might serve slightly different food, and again in a slightly different location. So these are slightly differentiated products. Now what's interesting is if you look at sort of textbook importance, so let me just carry these headings down to here. So I'm going to just rewrite M, P, C, O, and MC. So if you look at your textbook, this is very, very important. Just about every year there's a major question on the AP micro exam about monopoly. And not quite as often, but very, very often on perfect competition. And both of these get extensive discussions in the textbook. And this, for the oligopoly, gets less, and although it does get mentioned, and you do have to know it, the monopolistic competition even less. And it's every once in a while you will get monopolistic competition on the micro AP, but at least on our free response question. But you can actually, there are years where it doesn't even show up. Okay, now in the real world, okay, this is almost zero. I guess that governments used to grant monopolies back in the when the explorers were leaving the Europe to explore after Columbus discovered the route west and so on. So you had things like the Dutch East Asia Company or whatever it was called, and the British East India Company. Those were monopolies, but we don't see so many monopolies in the real world today, so it's close to zero. Essentially no industry is perfectly competitive. I mean, again, I could give the example of the maybe the commodities markets in Chicago, but for the most part there's no literally perfectly competitive industry in the U.S. Oligopoly, there's definitely some. I mean, I gave you the examples, and there are more. There are, the car companies. There are a few car companies. I mean, there really are quite a few oligopolies. And monopolistic competition, I would say just about everybody who's not in an oligopoly is in a monopolistically competitive situation. So there's this weird kind of inverse relationship that the textbook focuses on these examples, and the real world is filled with these examples. So I just thought I'd point out that little strange little anomaly. Okay, so the demand curve in each of these things. Do I have room to draw the demand curve under here? Maybe. So the monopolist faces a demand curve that is the market demand curve. Okay, because you're the monopolist, so you have the whole market to yourself, you decide which point to produce at, where you're going to get the most profit. If you remember from last time, that's where marginal revenue equals marginal cost. And we'll go into that next time when we go into monopoly in more detail, because we're going to be like the textbook and we'll focus on these two. But I will put plenty of emphasis on the other two just because they matter more in the real world. Okay, perfect competition, you face this really peculiar demand curve. Perfectly horizontal. So that's described in various ways. They say the perfectly competitive firm is a price taker, meaning if you try to set your own price, it doesn't work. If you set a price up here above the market price, there's so many competitors out there selling at the market price that you will sell nothing. And you're welcome to set a price below, but why do that? Because you can sell all you want, all you can at the market price. So you're just throwing away money. You're giving your product away cheaper than you'd have to sell it here. So you basically take the price that's at the market. That's what it means, a price-taking firm. You can sell all you want at the market price. Also, marginal revenue is equal to price. That is, every unit you get, every additional unit you produce or sell, so delta R, delta Q, every additional unit that you produce or sell gives you the market price in terms of revenue. So the marginal revenue equals price. So when we set marginal revenue to marginal cost for a competitive firm, what that says is that price will be equal to marginal cost for this perfectly competitive firm. Okay, so so you face a perfectly horizontal demand curve. You can sell all you want at the going price. The reason that you don't expand and expand and expand is because your costs get higher and higher, and we'll explore that when we talk about perfectly competitive firm. Let me go to the monopolistic competition firm. Monopolistic competition faces a downward sloping demand curve, but it's really only a fraction of the market. I was going to say part of the market, but a fraction of the market. So he doesn't get to have the whole market like the monopolist. He gets a fraction of the market, but it has some choice about price. He can set a high price and sell less over here. He can sell have a low price and sell more here. So it's not like the competitor where he's basically fixed on the market price. He has a choice to make about how much to produce and what price to try to set, or pick one of the others. Pick a price and that'll determine how much you can sell, or alternatively pick how much you want to sell and that'll determine the price you have to sell it at. The oligopolist I'm going to put off until we discuss the oligopoly, because they have no well-defined demand curve. And the reason is that the demand depends on the behavior of the other people in the market. So if Verizon cuts its price for broadband, or let's just say in the cell phone market, if Verizon cuts its price in the cell phone market, it can't predict how many additional customers it will get, because it depends on what AT&T does in response and what Sprint does in response. So we don't have a well-defined demand curve. So anyway, that's all I wanted to get across today, is that for each of these market structures there's a different demand curve. For the monopolist, it's the market demand curve. For a perfectly competitive firm, it's this horizontal demand curve that just fixes, you can sell whatever quantity you want, but you've got to sell at the market price. The oligopolist, no well-defined demand curve. And for the monopolistic competitor, you have a downward sloping demand curve like the monopolist, but we don't have the whole market like the monopolist. We just have a fraction of the market. And that's it.